Working capital management. This is a long reading in the curriculum. There is a tremendous amount of detail. You can obviously do the reading if you have time, but what I will do in this lecture is focus on the 7 learning objectives and emphasize the most testable points. As you've learned in earlier readings, working capital refers to a company's current assets and current liabilities which are used in the regular operations of a business. The way this reading is organized, there are a few high-level sections that give an overview. Section 1 is an introduction. Section 2 talks about how do you manage and measure liquidity. This is perhaps one of the most important aspects of this reading because it gives a lot of ratios for measuring liquidity. Managing liquidity over here is referred to at a high level. Almost all the ratios that you will see are ratios that you have covered in earlier readings, so this is important. We then get into the specific elements. If you look at these items, cash, short-term funds, accounts receivables, these all are current assets on the balance sheet. So we will talk about how to deal with each of these balance sheet elements. Inventory also is a current asset on the balance sheet. Then sections 7 and 8 move to the right side of the balance sheet. We talk about how to manage accounts payable and how to manage short-term financing. The introduction in the curriculum is extremely good. It's just over 1 page, and I would strongly encourage you to read the introduction because it sets the context very well. Here are the main points though. Working capital management involves managing the relationship between a firm's short-term assets and short-term liabilities. The goal of effective working capital management is to ensure that a company has adequate ready access to the funds necessary for day-to-day operating expenses. Another way of looking at this is that a company will have short-term obligations such as paying bills, paying salaries, and so on. The short-term assets and liabilities need to be managed in such a way that the short-term obligations are easily met. Different companies will have different working capital needs, and we need to understand the factors that impact working capital needs. This slide presents a list of internal factors and external factors. Let's go over the specific items. Company size and growth rates. Clearly, companies that are large and companies that are growing fast will have relatively high working capital requirements. Organizational structure. If you compare centralized companies versus decentralized companies will have higher working capital requirements because with decentralized companies, each business unit or division will try to manage its working capital, whereas with a centralized organizational structure, the cash management and receivables management and other aspects of working capital will be managed centrally, which means that relative to a decentralized company, the working capital requirement would be lower. Sophistication of working capital management. A company that is using a sophisticated system such as SAP to manage working capital will be able to do a better job of keeping working capital relatively low while still meeting its short-term obligations. Borrowing and investing positions, activities, and capacities. A company that can borrow relatively easily, invest relatively easily, liquidate relatively easily will have relatively lower working capital requirements. On the other hand, a company that cannot borrow easily will try to play it a little safe and maintain relatively high working capital. On the right, we list the external factors. Banking services. In an economy where banking services are very well developed, the working capital needs will be relatively low because it would be easy for companies to raise short-term funds. Interest rates. If interest rates are relatively high, then companies will maintain high working capital because companies would not want to borrow at high interest rates. New technologies and new products which make it easier to manage working capital would result in relatively lower working capital. The impact of the economy on working capital depends on the industry and on the specific element. For example, when the economy is not doing well, companies will cut down on inventory. On the other hand, companies might maintain higher cash balances because when the economy is not doing well, then generally liquidity is impacted and it is harder to raise money through banks and other non-bank sources. In a highly competitive industry, working capital requirements might be relatively high. Coming now to managing and measuring liquidity. Liquidity is the extent to which a company is able to meet its short-term obligations using assets that can be readily transformed into cash. Liquidity management refers to the ability of an organization to generate cash when and where needed. We need to understand the primary sources of liquidity and the secondary sources. Here are the primary sources. Cash balance. Obviously, a company can use its cash to pay off obligations. Trade credit. This refers to accounts payable when a company purchases from suppliers. If it is purchasing on credit, that is a source of liquidity. Short-term investment portfolio. Companies invest their money in T-bills and other short-term investments. If a company needs money, it is easy to liquidate the short-term investments and generate cash. Secondary sources of liquidity. These are sources of liquidity that companies generally want to avoid. Negotiating debt contracts. A company needs to make a large debt repayment but is having trouble generating sufficient cash, so the company will try to renegotiate the debt contract. Liquidating assets. Again, this is not a favorable position to be in. If a company has to sell off its long-term assets in order to pay off a loan, that would be a negative sign. Filing for bankruptcy protection obviously is a last resort. Drags and pulls on liquidity. Cash receipts and disbursements affect a company's liquidity position. We need to, at a high level, understand these two terms, drag on liquidity and pull on liquidity. We say that a company has a drag on liquidity when the receipts lag the disbursements. For example, if a company is slow at collecting receivables, whereas the company is making its payments on time, then this creates a drag on liquidity because the company is not collecting cash at a fast enough rate compared to paying bills. Obsolete inventory again creates a drag because the company is not selling its inventory, but the company is still making its regular payments. There are other examples also, but what you need to remember is drag on liquidity means receipts lag disbursements. A pull on liquidity represents the other scenario where disbursements are paid too quickly or trade credit is limited. If a company is paying its suppliers very quickly relative to getting money from customers, then we have a pull on liquidity. Reduced credit limits also creates a pull on liquidity. This could refer to reduced credit limits from banks. It could also refer to suppliers who are giving very tight credit terms. Again, there are other examples, but it's important to understand these concepts from a testability perspective. Coming now to measuring liquidity. Liquidity contributes to a company's credit worthiness. Credit worthiness is the perceived ability of the borrower to pay what is owed in a timely manner. High credit worthiness allows a company to obtain lower borrowing costs, obtain better terms for trade credit, have greater flexibility, and exploit profitable opportunities. These are fairly self-evident. A company with a high level of credit worthiness can borrow more easily at a lower rate. A company with high working capital and high credit worthiness can also exploit profitable opportunities because this company can raise money relatively quickly in order to take advantage of opportunities. Liquidity ratios measure a company's ability to meet short-term obligations. And before you go to the next slide, I want you to write down all the liquidity ratios that you remember from earlier readings. So here are some ratios that you should come up with. Perhaps the most important one is the current ratio, which gives the current assets divided by the current liabilities. If you recall from FRA, we also have other ratios such as the quick ratio and the cash ratio. The quick ratio has the same denominator, which is the current liabilities, but in the numerator we do not include inventory, because if for a given company the inventory is obsolete or it is not very liquid, then we want a ratio that does not include inventory. In some textbooks, you will see the quick ratio written as current assets minus inventory. And as we've discussed in FRA, there are no strict rules or formulas for ratios. You just need to understand what ratio is being used based on the context. We also have other ratios such as receivables turnover and payables turnover, inventory turnover, and so on. In FRA, these were categorized as activity ratios. But over here, you need to recognize that receivables turnover, inventory turnover also measure liquidity. A company that has high receivables turnover is collecting money from customers relatively fast, which is a positive sign from a liquidity perspective. As we've seen before, the receivables turnover is the credit sales divided by average receivables. Sometimes you might see only sales written over here. It depends on what data you have, but the important thing is when you are comparing the receivables turnover across different companies, then you need to use the same formula. The number of days of receivables is a measure of how many days on average it is taking to collect receivables, and that is given by 365 divided by receivables turnover. The way the formulas are given in corporate finance is slightly different from the way the formulas are given in FRA, but just to help you remember this better, I am using the same format that we used in FRA because the answer will be the same regardless of whether you use the formulas shown here or the formulas shown in this particular reading. Inventory turnover is a measure of how quickly a company is selling inventory. This is given by COGS divided by average inventory. Number of days of inventory tells you on average how many days of inventory a company has. This is given by 365 divided by the inventory turnover. Payables turnover is purchases divided by average trade payables. If purchases data is not available, then you can use COGS as an approximation for purchases, and the number of days of payables is 365 divided by the payables turnover ratio. When you are doing ratio analysis, you need to cover two dimensions. First, you need to look at whether liquidity is improving for a given company over time. That would be time series analysis. You should also compare the liquidity ratios of companies with other companies in the industry, or we can call them peer group companies. You want to see whether these ratios are above or below the average. This concept is covered well in example 1 in the curriculum, so I would encourage you to read and do this example. Net operating cycle. Here you need to understand the difference between the operating cycle and the net operating cycle, and we have seen this in FRA also. The operating cycle refers to the days of inventory plus days of receivables. The cash conversion cycle, which is also the net operating cycle, tells you how much time it takes between when you pay cash to when you receive cash. And to calculate the net operating cycle, you do the following: average days of receivables plus average days of inventory minus average days of payables. Let us consider a simple example. Say days of payables for a given company equals 20, days of inventory is 30, and days of receivables is 15. If a company purchases inventory on day 0, days of inventory equal to 30 means that it will sell the product after 30 days or on day 30. And if days of receivables is 15, then the company actually receives cash on day 45. From 0 to 45, which is the time between when inventory was received and inventory sold, that is 45 days. Days of inventory 30 plus days of receivable 15 is equal to 45. This is the operating cycle. With the net operating cycle, we are looking at the time between when cash is paid to suppliers till the time when cash is received from customers. So we take the overall operating cycle of 45 days, which is days of receivables plus average days of inventory, and then we subtract the days of payables. So 45 minus 20 is equal to 25. That's this period over here. This is the net operating cycle or the cash conversion cycle. If you get a question in the exam, make sure you are careful about whether or not the term net is being used. When you see net, that means you need to subtract the average days of payables. If you don't see net, then you are simply doing days of inventory plus days of receivables. Managing the cash position. Now we will talk about specific elements on the balance sheet. The purpose of managing a firm's daily cash position is to make sure there is sufficient cash. That sufficient amount of cash is called the target balance. A company does not want cash balances to become negative because it is expensive to borrow cash on short notice. Companies also do not want high cash balances because that would be inefficient usage of funds. Companies should recognize the major sources of cash inflows and outflows in order to forecast and manage cash position. Clearly, a company needs to recognize how much cash is coming in, how much cash is going out. Only if there is a view on cash in and cash out will a company be able to effectively manage its cash position. The specific inflows and outflows will vary from company to company, but at a high level, here are the typical inflows and here are the typical outflows. As an analyst, you can figure out the inflows and outflows by studying the cash flow statement of a company.